All right. Today is Sunday, the 21st of April. This is a recap for the stock market activities last week and an outlook for the week to come. And folks, I got a good one for you tonight. Hope everybody's having a great weekend. You're enjoying the beginning of the summer, shall we say? The sweet spot before it gets too hot. But what happened to this this bull market everybody been bothering us about? Oh, it's the greatest bull market of all time. All of a sudden, stocks are crashing by 10-20% in a single day. It seems that the financial experts are now changing their minds a little bit, that maybe it's not really a bull market. Just like the medical experts, right? They tell us one thing is good for you for years, and then after you gobble up a mountain worth of that thing, they come out and said, oh, did we tell you that that's going to be good for you? Actually, that gives you cancer. You're going to be dead. They change their minds all the time. It's like the oldest form of therapy ever known to man, owning a cat. We knew that this is good for you. It's good for your mental health. But now the medical experts come out and they say having a cat can actually double your chances of developing schizophrenia. And rumor has it, these are the medical experts that came out with this study. And folks, relax. If you have a cat, you don't have to throw them out of the window. It's a bullshit study, proven by hundreds of years worth of cat ownership. You look at all of these old ladies who make it to 100 years old plus, they always got cats. So give me a break. I don't trust folks who don't love animals. Doesn't matter what they are. Dogs, cats, doesn't matter. When I used to date, the moment in the conversation when the girl tells me she doesn't like cats, I grab the napkin, wipe my mouth, throw the napkin on the table, and walk away as fast as I can. I don't even bother paying the bill. They give me those witchy vibes. Run. Red flag. Although if she likes cats too much, chances are she's a lesbian. But anyways, folks, these are all jokes. You don't have to call your therapist. It's late at night. They'll charge you more. Anyhow, in other news, the flying coffin, Boeing, is now aiming to bring us flying cars by the year 2030. And you know all of this fuss about AI. Oh, AI is going to change the world. Bullshit. AI is going to take your job away. Number one, it's going to serve the oligarchy. And the other contribution from AI will be giving men another source to jerk off to. We now have the first AI beauty pageant. And the impossible, the really high standards that we can't apply to real human beings, forget about those. They apply here. These AI broads, they don't age. They're all 5'10", they're all subservient and romantic and loving, and they cook and clean. They don't nag or complain or ask for too much. So for the ladies, human beings watching the show right now, sorry, but you're gonna go extinct. We might have to classify you next to the rhinos and the penguins and all of that. On the other hand, a lot of people love to donate to these causes, but with the new generation of men who got all kind of mental problems and they're already disassociated from society to begin with, oh, you bet they're going to fall in love and jerk off and have relationships with the AI women instead. So you might want to embrace your cats and become lesbians, because that's the only route left here for you. Anyways, what the hell are we talking about here? Let's talk about the financial markets and what's going on with the world, the real world, not the bullshit news. Believe it or not, when we talk about AI being fugazi and just a hype, that's what it really is. And this week exposed it all, because when we look at the wall of hope for the market, we only got two items now. The hopes for rate cuts and the AI hype. It's not even hope, it's hype. And this week, both of them went out of the window, and this is why the market got really, really upset. Then you look at the wall of worry, on the other hand. You got the whorehouse in D.C., we'll talk about that in a minute. You got the elections risk, you got the geopolitical risk, Israel, Iran, China, Taiwan, Russia, Ukraine, and soon enough we'll have Germany, France again. Then you got China's economy. That's not doing so hot, and it is a source of concern. And of course, what happens if we don't get rate cuts and we get rate hikes instead? That's the wall of worry, and the items in the wall of worry were more active than the disabled items in the wall of hope this week, and this is why, all in all, the dynamics of the market were negative. We will discuss some of these items in the wall of hope and the wall of worry in tonight's program. We begin with what else? The whorehouse in D.C., also known as Congress. Folks, if you believe that your beloved politicians who you vote for all the time expecting different results, if you think that they work for you, it's about time to wake up. On Monday, you paid your taxes, so mission accomplished. They worked your ass all year long in corporate slavery. 2-3 jobs. You got high blood pressure, medications, balding head, but you paid your taxes. And that's what really matters. Your health, your happiness, your well-being, who gives a shit? Pay the VIG, go back to work, and we'll see you again next year when we have to collect taxes again. But since you already paid, now all of a sudden Congress comes out and says, hey, we passed a $95 billion aid package. Oh, nice. We're getting an aid package. Inflation is going way too high. We got homeless veterans all over the place. Home affordability in the toilet. The education system is crumbling. You get sick, you try to get some health care. You're treated like an animal in this country. And you're probably going to be left with a medical bill that will bankrupt you. So yeah, thank you so much. The government has finally given us $95 billion worth of... Whoops. I'm sorry, folks. The headline reads, U.S. House passes $95 billion in aid to Ukraine, Israel, and Taiwan. Nothing for you, dear American bums. Zero. Go back to work, keep your mouth shut, and enjoy this democracy we're living in. And my only comment to all of this is treason. That's what it really is. Abandoning your own people, your own issues domestically, and robbing that money, taxpayer money, to send it to foreign countries to fund proxy wars and money laundering. When you have the national debt now reaching $35 trillion, and oh, by the way, rates are going higher and higher and higher. We're now paying $1 trillion plus in annual interest payment alone. That is more than the entirety of the military budget of the United States of America. And with adding more debt, because all of this money that they stole right now is coming from other spending programs. So at some point, the government will have to go on and borrow more, billions of dollars, which will ensure the rates will continue to stay higher and higher and higher. Are you really sure that this is sustainable? But do you think that your beloved politicians give a shit about this country or its people? Of course not. It's up to you, the people. You are the ones who are going to point to this as a problem and do something about it, because they're not going to do anything about it. They don't work for you. They work for the highest bidder, the donors, the oligarchy. And if you thought this is a democracy, joke's on you. It's not. It's never been really a democracy, especially now. It's a military junta who rule the country. Then, of course, comes the intelligence apparatus up Uranus. And what rules them all is the oligarchy. And this is why we see the billionaires always coming in and out of the Pentagon. Those three, the entities that rule the country, the president, the politicians, they change faces like cards. Doesn't really matter. Democrat, Republican, doesn't really matter. And they're making a big deal about this Ukraine package because, if you don't give Ukraine the money, $50 billion of your money that you work so hard to make throughout the year, if you don't give them that, you'll lose your democracy because the Russians will take over Ukraine. And the question that I have is, what do I give? Is Ukraine in Missouri or is it thousands of miles away? But of course, this is according to the CIA director who said that Ukraine will lose in 24 if we don't give them billions of dollars of taxpayer money. Of course, the intelligence apparatus up Uranus, such as the CIA, they have different agendas and priorities than the American public. And my question is, okay, we gave them $100 billion last year. Where did that money go? Remember the counteroffensive? We gave them all of that money and weaponry. Zero results. The Russians took over more land. Should we at least question? Wait a minute here, is the money even working? Can we see some results before we send more? And what about all of the money that's being wasted in corruption by Ukrainian politicians and oligarchs? Millions of dollars in villas in Spain and luxury cars with no accountability at all. But of course, they don't give a shit about Ukraine either. I'm talking about the military juntas, the intelligence apparatus up Uranus, the oligarchy who ruled this country. Believe it or not, they don't give a shit about Ukraine either. They know it's not a democracy, and if it falls, who gives a shit? It wouldn't change anything at all. They care about something else. They care about Russia. They figured out that in the 21st century, China is going to be our main problem. But we still got Russia, huge military power with nuclear weapons, and we can't fight both China and Russia at the same time. We got to neutralize Russia. And the brilliant way they found out how they can do that and concentrate all of their efforts against China is to drag Russia into an endless war with Ukraine. And all what we have to do is just pour more weapons and more money into Ukraine, and the Ukrainians will keep fighting the Russians for us and make them weaker. And then at some point, Russia becomes irrelevant. They lost so many weapons and military gets degraded and they lost so many men. It doesn't really matter anymore because Russia is only a military threat. It's not an economic threat like China. That's the whole plan. That's the whole motive behind what we see right now. And fortunately for them, the geniuses that they are, the plans are not working as they anticipated. At some point, you got to cut it off and rethink. For example, the IMF came out this week and said that Russia will grow faster than the US and all other advanced economies this year. I thought we're sticking it to Putin with the sanctions and the war and all of that. And now you got the propaganda minister Elon. She comes out, she says, we're going to sanction Iran too. How'd that work with Russia? Now we're going to sanction Iran. Okay, good luck with that. Furthermore, Russia now is more dangerous than ever before. Believe it or not, before the Ukraine war, they had no ground military experience at all. The moment they invaded Ukraine, it was proven to be a joke. The Russians got exposed right away. But now, 2 years in, they got a lot of ground experience, which we don't have, because we haven't been in a real war in a very long time. So, believe it or not, Russia strengthened, not weakened. Number 2, they're outside of the nuclear treaty, so now they can develop their nuclear weaponry with impunity. But the problem is the folks who designed all of this plan are a bunch of egotistic maniacs. And they don't want to admit defeat and change strategies. They want to keep digging in, and they just want more and more and more of your money. And if you're worried about inflation, if you're worried about home affordability, lack of health care, deteriorating infrastructure, borders wide open, all of the problems that we have in this country, that's not the priority, dear America. It's we got to send the money to Ukraine first, and then we'll come back to you. And I say, since we have a lot of hot-headed viewers and a lot of hot-headed Americans who actually support sending money to Ukraine and all of that, I say any big mouth who wants to send our money to governments overseas should volunteer to do so by paying extra taxes to fund them. Don't parasite on other hard-working taxpayers' money. There should be an option when you pay your taxes. Would you like to donate to Ukraine, Israel, Taiwan, Zimbabwe, whatever country you'd like? And you put a check mark and you write exactly the amount you want to give to Ukraine, Israel, whatever you want. But don't put it on the backs of other hardworking Americans who are paying taxes. Especially these billionaires like Bill Ackman, for example, comes out and says, yeah, we're saving democracy. Great that we're passing a $95 billion package to fund Ukraine. Okay, Bill, why don't you pay more taxes? You pay the billions of dollars and spare average Americans from that burden. Spare our country from racking more debt on top of what we already have, so we can spend our money where it belongs, in the prosperity domestically of the American public. And you guys pay whatever you want to pay to Ukraine or Israel, Taiwan, doesn't matter to me. I wouldn't care much. But of course, they want to use your money because they have no respect to you. To them, you're just dispensable. Your job is to go down and work your ass off, pay your taxes, do what you're told, and keep your mouth shut. They don't respect you. They don't fear you, certainly. And that's the problem. When you want to talk about losing democracy and all of that, when you're a taxpayer, you work your ass off, you pay thousands of dollars, hundreds of thousands of dollars, in my case, millions of dollars in taxes. Shouldn't you have a say where that money goes? In a real democracy, shouldn't you have an opinion at least and a say where that money go? But we don't. We don't have a say. The politicians take the money and do whatever they want to do with it. Haven't we already lost our democracy then if we don't have a say? And that's the bottom line. And as far as the two other countries, Israel with, $20 billion that we're giving them right now, and Taiwan over $8 billion, these two countries are so rich, they have better standards of living than we have here in this country. Most Americans would dream to get sick in Israel or Taiwan and enjoy the superior healthcare system that they have in those two countries. I'm fine with selling them weapons, but they have to pay for it. We'll give them a payment plan, with interest, of course. We're not the Salvation Army. Just give countries shit for free, especially rich countries like Israel and Taiwan. They have to pay for it. But of course, again, they don't work for you. Now, what are you going to do about it this election season? You going to do the same thing, or would you change tactics at this point? And the end impact from all of this, folks, like we said before, this is money that we don't really have. They're going to take your taxpayer money right now to pay for it, but it's going to come out of something else. And that something else has to be plugged in by borrowing more money, which means that interest rates will stay higher. Why? Because when the government continues to borrow more and more and more, well, we have almost $35 trillion in debt. Well, the buyer of that debt will demand higher interest rate because the risk is increasing. And as they demand higher interest rates, and you see the auctions, by the way, that we have, 10-year bond, 20-year bond, 30-year bond, disastrous. The demand is not good. They want higher yields, which means the rates will stay higher for longer, whether the Fed likes it or not. And that's going to be disastrous for this economy and unsustainable for the degree of spending that we're doing. Otherwise, we'll be paying $2 trillion in interest payments alone in no time. And the other problem that I see with all of this is now we're heading into the election season. Whatever spending we're giving to Ukraine, $60-70 billion, God knows how much, in reality, of course, they're not going to see tangible impact from that money. Unless, of course, the corruption that the Ukrainian politicians do in buying luxury cars and drugs and Spanish villas, of course, that's going to happen immediately. But as far as weaponry in the field, training, etc. that's going to take a long time, which means that the Russians have a calculation to do here. What they're going to think about is, okay, we have an election season coming. They sent all of these billions of dollars. We're going to send them a message back. And that message will be, we're going to ramp up the military campaign and cause a major defeat in the battlefield right before the elections for the West and Ukraine. And now they're aiming for the city of Kharkiv again. If the Russians take it, and they can, because that money's not going to come out until later, that would be the end of it. That's going to seal the deal for the Biden administration. Because comes the election, the argument would be, economy is in the toilet, inflation never went down, and oh, by the way, the stock market you've been bragging about, that's crashing down, and all of the money that you stole from the taxpayer to send to Ukraine, not showing any results. The Russians actually took another major city. There is no argument left after that. And in my opinion, the Biden administration is taking a lot of risk before the elections, and it's not paying off. Economically, geopolitically, it's not paying off. But we go back to the wall of worry because we're done with the House of Evil in D.C. Let's talk about the geopolitics because that was the main concern until Friday. Why? Because we got the Israeli response to the Iranian response, and it was tame, it was mild. It was a bunch of drones that got shot down, and nobody's really talking about it. The Israelis never admitted anything, and the Iranians downplaying it, according to the Washington Post. And even the New York Times says muted reactions to Israeli strikes on Iran hints at de-escalation. Now look, maybe the Israelis are playing a game here where they send an initial response that is really weak and everybody assumes that's it, and then out of the blue they strike and they give you the real response. But absent of that scenario, I think right now the Israel-Iran front in the geopolitical risk is on ice. Iranians did their thing, the Israelis did their thing, and now it's just quiet. Let's see what happens next. In the meantime, the bill by Congress reignites the geopolitical risk re-Russia-Ukraine. So that's going to be the main focus for the market in the next few months, unless, of course, Israel-Iran flares up again, or, God forbid, China-Taiwan, something happens over there. So that's the geopolitical risk, not the most immediate concern right now. What else do we got in the wall of worry that is worthy of talking about? How about the Fed? And it goes with the wall of hope, by the way, that rate cuts are not going to happen. We've been saying this numerous times in this program, that you cannot defeat inflation without a recession. And if the Fed plays the game of declaring victory prematurely, then they're doing the same mistake from the 70s. Because inflation will come back. The moment you ease, inflation comes back. You have to kill inflation, and the only way to do that is to create a recession in the economy and accept a market crash. Absent of that, inflation will never go away. So now, Mr. Powell, Zombie Powell, who bragged about defeating inflation last December and created all of this mania in the stock market, which investors will pay dearly for, specifically retirees, because the coked-up managers took all of that retirees' money, pumping it in the market despite the valuations because, the Federal Reserve promised us rate cuts, so it's a no-brainer, you gotta buy. Well, now we realize, whoops, the Federal Reserve actually doesn't know what the hell they're talking about because they're not in charge, inflation is. They become in charge if they grow a pair of balls, which they're not gonna do that. So for now, inflation is in charge. And the headline reads, Fed Chair Jerome Powell has an unfriendly message to markets. You might not be getting any rate cuts this year. Whoops, already. Who would have seen that coming? Perhaps a better headline is this one right here. Fed Chair Powell backed himself into a corner. There we go. Now we're talking. Don't write headlines making Powell seems like a wizard, because he's not. He's an imbecile. And he's going to be proven to be worse than Arthur Burns from the 1970s. But anyhow, Fed Chair Powell backed himself into a corner by predicting rate cuts this year and is now in a tricky situation, according to this chief investment officer. Now, the market is going to, at least to a degree, tolerate the game of, okay, the Fed said they're going to cut rates in March, maybe a little too soon. May. Okay, May is a no-go. How about June? June is a no. How about July? July is a no-go. How about September? Okay, September is no. How about December? Oh, December is a no-go. How about 2025? The market will play that game of pushing rate cuts down the line, and there will be a degree of tolerance. But the moment the game changes from delaying the rate cuts into interest rate hikes, it's over. The market will crash rapidly. You wouldn't even be able to wrap your head around it. By the time you're thinking about hedging and shorting, the market is already down 20-30%. And you've seen a taste of that last Friday. The only thing that the Fed has to brag about right now is the jobs market is holding really strong. But we don't really know the reality of the jobs market. On one hand, we know that jobs, meaning employment, is the last element of the economy that breaks. So usually by the time you see the unemployment rate rising higher, it's already too late. The increase in the unemployment rate is actually just a confirmation of a recession and a crash. And the other thing we have to be aware of is, do we trust the government data about what's going on in the employment market when a lot of companies announcing layoffs, private data showing job losses all over the place? This week we got a headline that's really peculiar. It reads, "Something strange has been happening with jobless claims numbers lately." Most of the past several weeks have shown the first-time claims of unemployment benefits haven't fluctuated at all, as in zero. A string of weekly reports showing exactly 212,000 initial claims has raised a few eyebrows on Wall Street. A Labor Department spokesman noted that while the string of 212,000 print, that's the keyword, because it's not really a real piece of data. On the jobless claims data is quite uncommon. It can be attributed to consistent jobs picture reflected in seasonal adjustment of the data, really. Or maybe you guys are just cooking the numbers, and that's why the number is not believable. It just stayed static for weeks. And God knows what the reality of the jobs market really is. We have to rely on anecdotal evidence. We have to rely on private data because the government has weaponized every piece of economic data, and there is no transparency anymore. And in a nutshell, this week marked the defeat of any hopes of interest rate cuts. And they actually moved the risk of interest rate hikes significantly higher. And this is why you see the market upset. But then I think the most important development that we've seen on Friday, because you got to remember, overnight we got the Israeli response and the market shrugged it off in the morning. Oil was actually down. There was a reaction, positive reaction initially, and then it went down. We realized that the strikes were insignificant, but the market went down in a big way Friday. Even though the breadth of the market was actually pretty good, other stocks besides the technology and AI stocks were doing pretty good, caught a rebound. But the AI stocks, technology stocks got hammered. And I think that's more of an important dynamic to the market than the geopolitical risk or any risk really, is what if AI hopes are false and they were transitory? And now we're seeing the bubble bursting. What piece of data caused the scare on Friday? We have to go to earnings. And we got Taiwan Semi, TSMC, most important company in chip manufacturing really. The world's largest chip maker, TSMC, posts its first profit growth in the year with a 9% rise in net income to $7 billion in the first quarter. Okay, so that's good news. Why was the stock down? Why did it cause a scare in the AI mania? Well, here's another headline from the Wall Street Journal, and it reads, TSMC shares fall after downgrading 2024 global chip outlook. Well, we have to look at the numbers because we have conflicting headlines. Let the numbers speak. And a reminder, in the last video for the members, we've done ASML, and sales went down by 22%. Versus expectations, so that was a disaster. We covered that earnings report in details, but we'll give you some of the highlights in this video too. But let's begin with what we really care about. We look at the year-on-year revenue growth. We look at the year-on-year cost of goods sold growth. We look at the year-on-year expenses growth. What we love to see in any report is that the rate of growth in revenues year-on-year is exceeding the rate of growth in the cost of goods sold and expenses, because that suggests sustainability in expanding margins, aka net income, which is the next category we care about, the year-on-year net income. In certain cases, you might see positive net income growth year-on-year, but if the rate of growth in revenues is lagging the rate of growth in the cost of goods sold and expenses, it could be an early leading indicator that sooner than later you will see negative growth in net income year-on-year. So this is why we care about these categories. And then we look at the sequential revenue growth and net income growth. Why is that important? In bubbles, specifically, as we have right now in the chip makers stocks and the AI mania, would you want to spot the peak of the mania when things begin to move to the south? You have to look at that sequential reduction in growth quarter over quarter, be it in revenues, but specifically in net income. That leads you that perhaps the company's losing its transitory tailwind that led to the expansion in the top and the bottom lines. So with that in mind, here it is, the year-on-year revenue growth for Taiwan Semi, up 16.7%. That's pretty good. But then the increase in the cost of goods sold, exceeding the rate of growth in revenue, up 25.2%. The rate of growth in expenses year-on-year, 18.2%, also higher than the 16.7% for revenue. So right off the gate, even though we have net income growth year-on-year, up 8.8%, these ratios are not good. They lead us to see contraction in the growth of the net income for the company in the next few quarters. Then you look at the sequential growth of revenue, down 5.3%, and for net income, down 5.5%. So this is not good, specifically for a stock that's already trading at all-time highs. It's not the most awful results, really, but it doesn't justify the valuation of the stock. And if you thought this is bad, look at what happened with ASML. Revenue growth down 21.5% year-on-year. Cost of goods sold minus 22%, so that's good, but expenses up 5% year-on-year. The net income growth down 37.4% year-on-year. Sequentially, revenue down 27% and net income down 40.24%. If you're an observer of the market and you're looking at these two companies and they're showing major slowdown in growth, you gotta question who's next. Is it gonna be NVIDIA? Is it a leading indicator for the most important stock in the world right now? I think that's what led to the fear that we got on Friday. Now, if we look at Taiwan's, and this might be a little hard to see, but anyhow, what we're looking at here is the net income in billions quarter after quarter. And you can see right now that we thought that the trend is increasing. But based on the numbers that we got in the latest report, we're dipping down again, which means that the peak was already in 22. So why is the stock price trading at the same peak of 22? There's a misjudgment. There's mispricing. The stock should be trading way lower to reflect the fact that net income growth is actually slowing down again. Now, next week, we have important earnings. We begin Monday with Verizon. Then Tuesday in the morning, we have GE, UPS, Lockheed Martin, PepsiCo, and GM. And then in the afternoon, we have Tesla. So we're going to preview Tesla's earnings in a minute because this is going to be the most important one of them all. Wednesday in the morning, we have Boeing and Ford. Then in the afternoon, we have Meta, IBM, and ServiceNow. Thursday, all of these earnings come after the bell. We have Roku, Alphabet, Visa, Chipotle, Microsoft, Intel, and Snapchat. Friday, important day for oil. We have Chevron and Exxon, along with the pharmaceutical giant AbbVie. Now, the most important earnings, in my opinion, will be Tesla. Some folks say that whatever bad news we're going to get out of Tesla, it's already priced in. The stock is down 40% for the year. Others would say, no, the news is so bad that 40% doesn't even begin to price in the disaster, and we need to shave more of the value of the stock. We've been in a slew of bad news from this company. When it rains, it pours. We got the news that the company now laying off 10% of the workforce, and they did it in the nastiest fashion that you can imagine. Employees showing up to work only for their badges to be taken away and they're sent back on shuttles. You're fired. You got no job anymore. Go home. On top of that, when folks got their severance package, it was way too low. And that was yet another slap in the face. A lot of Tesla workers are sharing their stories. I had to relocate across the country. And 6 months later, they give me the pink slips. What is the lesson from all of this? If you're an employee at a company where the stock went down significantly recently, there was a huge chance you're going to lose your job. Folks say that the stock market is not the economy and vice versa, but at the end of the day, the economy is influenced by the stock market, specifically when it comes to unemployment. You see, for example, Lululemon now firing employees. Why? Because the stock crashed recently. Stocks that are trading at all-time highs, they're not letting go of employees yet. So it's really important for you to look at the stock of your company, your employer. And if it's crashing, be careful. You could be in the chopping block next. But the bad news for Tesla doesn't stop here. They're slashing prices even more now for the Model Y, Model X, Model S, because there is no demand anymore. The market is already oversaturated, oversupplied, and demand is getting weaker by higher rates. So you have a really awful combination for the company where they have to continue to slash pricing and accept lower margins, even losses. We'll see what the report says. And the company now even slashing the FSD software program, the full self-driving software, by $4,000 to incentivize demand. Now, what if that doesn't really stoke demand in the market? And now all what you're doing is just pissing off your existing customers who are now sitting on negative equity for the car, for the FSD program. They overpaid and now the price is all going down. One has to question the reliability of owning a Tesla. If I buy it right now, then prices crash. Should I really jump in and buy this car? On top of that, we have more and more bad news ahead of this report. For example, EU March sales for Tesla, the biggest drop in 16 months. Car registrations down 30%. Electric car registrations down 11% in the EU. And the EV market share in the continent went down to 13% from 14% year on year. So you see demand going down, and again, whether that's priced in or not, usually stocks bottom at bad news. But if the stock is not pricing in the magnitude of the bad news, then we have further downside to go, and this is why I think it will be the most interesting report this week. Now, in face of all of this bad news, investors losing over 40% of their investment this year alone in Tesla, the CEO has the audacity to ask investors to approve a reward worth $55 billion for CEO Elon Musk. Now, any rational investor would say no way, but the culties, of course, they're so submissive. I thought they're going to approve the package easily to Reverend Elon Musk. But now we're seeing a little bit of a rebellion where the culties are saying, wait a minute here, why should I lose? And he gets $55 billion. No way. Go down to the factory floor again, fix the problem, then you get your $55 billion. When you fix the stock, when it's up 40%, not down 40%. And every shareholder should be voting the same way. No package until he fixes the problem. The thing is, I'm not sure that the problem is fixable. The problem is a company, an automobile company, that's what it really is, that was hyped up so much that the valuation went to the moon. And now the company is facing classic automobile manufacturer problems. You have to trim that valuation, and there is no easy fix. You got an oversupplied market and reduction in margins. It takes years to fix that. In the meantime, valuation has to be trimmed down. It is a significant challenge for Tesla. Now let's talk about the market really quickly, because if Tesla falls, then we see Meta fall, and then we see Microsoft and Alphabet going down. That could be a disaster for the market, which, by the way, now yielding less than T-bills. The Nasdaq is yielding less than T-bills. There's no point of owning stocks right now unless you want to experience the thrill of a roller coaster ride. But other than that, the risk-free rate is giving you more than the returns of the Nasdaq. But also, as we look to this week, we know that we got a really steep sell-off on Friday, sort of a climactic move. The assumption now becomes, can we squeeze in a rebound for whatever reason and then head lower again? I think that's the assumption, but we have to review Friday's session, folks, because it was an epic session and it produced the kind of gains that you see once every 3, 4, 5 years, and it all happened in one day. So let's go and review the morning brief on Discord from Friday. Here it is. Good morning. It appears that overnight geopolitical tensions are being faded as the Israeli response appears to be very limited. We see evidence shows in crude oil futures, which went negative from being positive by over 4% overnight. No one knows whether this is a throw-off by Israel before a larger surprise attack or whether we will see Iranian counter-reaction to it. So the behavior of the VIX will be telling. If it closes the morning gap and trades below, we will likely sustain a market rebound today. If the VIX continues to trade above the gap, then we might see some initial rebounds in the market to play OPEX, then the market sells by the end of the day. Now, understand this, and we said this in the last program. The market tried to rebound Tuesday, Wednesday, Thursday, and it failed 3 days in a row. If that is the case, and we head into Friday, then the risk becomes for an inverse gamma squeeze. Boy, we played it beautifully. I'm going to focus more on OPEX and market dynamics in my early trading today, so I will trade Tesla 150 or 155 calls for next week as a day trade. And since chips are being sold, I will also trade or day trade the 800 puts on both NVIDIA and SMCI supermicrocomputer with the expiration date of next week. I will enter these trades upon the open. If you don't know how to manage day trades, don't follow. If you didn't follow, you missed probably one of the greatest opportunities this year so far. Because we know what happened to NVIDIA and Supermicro. NVIDIA went down by over 10%, and then Supermicro crashed by more than 20% in a single day. So those puts, ladies and gentlemen, at least the ones on Supermicro, netted over 2,000% worth of gains in a single day. Now, the premiums were high to begin with. You probably didn't invest $1,000 in playing these puts. A lot of you played $100,000 plus in these, which means we scored over $2 million worth of gains in one day. It's really a couple of hours, not even one day. So sure, we might have lost on the day trade for Tesla calls, and I did. I didn't close it, so I lost a little bit of money in the calls for Tesla, but boy, the gains for Supermicro were so big they can choke an elephant. I mean, think about traders who made $2 million in a couple of hours trading these puts in Supermicro. How long do you think the average American has to work before they make $2 million? The answer is a lifetime. If they're lucky, of course, they'll make $2 million by the time they retire. Some folks made that money in a couple of hours. Now, what are you saying, Maverick? Are you saying I should quit my job and gamble in the stock market? No. All I'm asking you to do is just think about that for a moment. Think about how long it will take you to get to that number, and some folks made that in a day. In this Ponzi scheme we call the stock market. And okay, it might have been a trade on a silver platter was so obvious. Now I want you to think about the Wall Streeters who are making these moves every single day because they're not gambling. It's not a gamble when you have insider trading, when you know what's going to happen beforehand, when you're getting the information, who's going to sell, who's going to buy ahead of time, and you're just following. It makes you question the realities of the American economy. We're told work hard, follow the rules, save your money, and you'll make it. But these guys making more than we were going to make in our lifetimes. And they make it in a day, and they don't lose because they have the insider information. Think about that for a moment. It reminds me of the scene from Wall Street when Gordon Gekko explains to Sport that at the end of the day, the majority of the money that comes from this economy is coming from inheritance or speculation. It's not really speculation when you have insider information. It's bullshit, he says. And then think about the average American working their asses off, and they got nothing.
It's bullshit. You got 90% of the American public out there with little or no net worth. I create nothing.
And the other thing I want to say is to the perma pumpers and chasers, keep calling us perma bears and missed on the rally, and you're wrong because at the end of the day, this bubble is going to crash in your head. And if you didn't book your gains, you will end up being a victim at the end of the day in a very expensive roller coaster ride, the largest transfer of wealth in the history of humanity. You chase, I hunt. That's what you don't understand. I don't give a shit if Supermicro goes up by 100, 200, 300%. If it's a bubble, if it's based on bullshit, I'll take it on the way down. I'm going to hunt it on the way down and make millions and millions and millions of dollars. Question is, will the chasers keep their money? You chase, I hunt. That's the message of the day. With that, folks, let's move on and add more color to this conversation by covering the market information for you. We begin with the closing of the indices last Friday, and here we go. The diamonds in the green by 211.02 points or a gain of 0.56%. The Nasdaq is the laggard of the day, down by 319.49 points or a loss of 2.05%. Likewise, the Spider closing in the red, down by 43.89 points or a loss of 0.88%. And the small caps Russell 2000 is actually positive by 0.30 points or a gain of 0.16%. So you can see right off the gate the problem on Friday came from technology. When we do the sectors, all of them in the green really, led by utilities, energy, financials, defensives, all positive. What's in the red? Technology down about 3%. Comm services, cyclicals down, and that's mostly Tesla to be honest. So Friday, the market did rebound. It was a huge rebound. Technology. The AI mania. And the leader of the day was the defensive, the risk-off utilities. Let's contrast this picture with the weekly performances and let's see what's going on here. Well, again, it's risk off because we see utilities and defensives, number one, number two. Technology shaved off over 7.2% of its value. And then you got real estate down too. So what does that say? Rates are going higher. And when rates go higher, real estate is the most sensitive. It is the risk-on, rate-sensitive asset. So it goes down. Utilities is the risk-off, rate-sensitive asset. So we see utilities shine even though interest rates and bonds go higher. And technology, of course, that's the de-risking out of the AI mania. I mean, look at the breadth on Friday. It was positive. Believe it or not, NYSE 69% advancing, only 29% declining. The Nasdaq 49% advancing versus 48% declining. You look at the heat map, positive across the board. Energy up, utilities up, healthcare, huge gains. Amgen up over 2%, Pfizer up almost 2.5%. In staples, you got major gains. Coca-Cola up over 2%. In industrials, we see the defense contractors up. We see the value names like Honeywell up over 1.5%. But the mania names like GE and Eaton, those are down. Caterpillar, those are down. You look at the banks, the financials, all rebounding on Friday. You look at the comm services, the value ones, AT&T, Verizon, all positive on Friday's session. Where's the problem? The problem is in the big caps. Meta down 4%. You got Amazon down 2.5%. You got Microsoft, Apple down about 1.25% apiece. Then you got the wreck in the chip mania. NVIDIA down 10%. AMD down. The manufacturers down. Supermicro down over 20%. This is why we've seen the indices down. It's de-risking from the mania names. That's what it's really all about. I mean, you see it in healthcare too. Eli Lilly's down, the rest of the sector is up. So we're just de-risking out of the manias, out of the bubbles, and rotating toward other sectors. It suggests that the market is ready for that rebound. It's already rebounding, and the big caps will also catch a short covering rally, a rebound. That's inevitable. So the odds say that we're going to try to rebound this week. But the moves that we've seen this Friday, these moves are telling that you're better off buying the names that are lagging, buying the names that are not in mania, not buying the dips in names like NVIDIA just because it went down 10%, because it's going to rebound 2-3%, but then it's going to go down again because a new batch of sellers will show up. We contrast the daily heat map with the weekly heat map, and it gets a little uglier. You see that utilities, the only sector in the green positively, then you have the geopolitical risk, so we see some energies manage to close in the green, but in industrials, you see the defense contractors such as Lockheed was up about 3% for the week. Of course, we see rebounds in the healthcare insurance names, namely United Health after earnings, but we see decent gains in the staples. That's yet another defensive sector, so whether you're looking at PepsiCo, you're looking at Coca-Cola, Procter & Gamble, General Mills, Conagra, all of these names gained this week because the market is shifting toward risk off and getting out of risk on. So you see a slaughter in the big caps, in Tesla, in the chip mania, in software, huge losses this week. But even in the names, the mania names, the bubblicious names, within industrials, like GE, Eaton, those are down big for the week. In healthcare, like Eli Lilly, that's also down. The message once again is clear. Stay away from the manias, stick with regular stocks from now. We'll look at the heat map for the ETFs for the week. And again, TLT down, which means that yields were higher. Right off the gate, we see any yield-sensitive risk on, though. Yield-sensitive risk on, such as IYR Real Estate, XHP Home Builders, XPI Biotech, all getting wrecked. The only exception is the KRE regional banks, and that's due to earnings that we got a slew off this week. But the IWM is also yield-sensitive risk on. Small caps were down big this week. Yield-sensitive risk off, such as the XLU utilities, XLP staples, those managed to shine this week. So it was a defensive formation this week. It wasn't even an inflation bet, because you look at the XLE, XOP, OIH, USO, any energy ETF, those were down big. But then we have gold, GLD, SLV, those did okay. And that tells you right off the gate that the market decided to shift into a defensive posture, not the risk on in technology, and not even the inflation risk on in energy and metals, because the XME was down. But you have the GLD gold up, and you have the ultra defensives and utilities and the XLP staples going up. Whether that defensive posture sticks or not, it depends on what we get from earnings. So for example, if Microsoft comes out okay, if Alphabet comes out okay, you'll see us coming out of utilities and staples, buying more dips in the technology and chip sectors. Although I don't think that's going to last, because the main problem is not that we are concerned about earnings collapsing in these companies like Microsoft and Alphabet. The concern is that interest rate cuts are not going to happen, and the valuation that we pumped into these equities are pricing in a lot of rate cuts. So there's a pricing adjustment that has to follow. So for now, we say that the market will be in the fade the rip mentality, so long as we have the fears of no interest rate cuts and the possibility of interest rate hikes. Let's move on to commodities. This is the closing on Friday. We have positive closings for energy, but way off the overnight session highs. And then we have softs. What's new? Cocoa is moving higher again by about 6%, although we see pullbacks in OJ and lumber. Lumber was down about 2%. We look at metals, positive across the board. Copper is in a breakout. Gold, silver, although we'll look at the charts in a minute, I think these two are getting closer and closer for a pullback. Platinum was the loser on Friday, down about 1.25%, but then we see grains futures sustaining some gains. We've seen the majority of the gains coming from the news of the strike overnight, while energies faded the gains, grains kept the gains. Is there a message here? I'm not sure. We need to see how sustainable these pumps that we got on Friday. By looking how wheat, which was up about a little over 2.5% on Friday, or corn up a little over 1.5%, and then soybeans also up about 1.5% on Friday. We want to see how these gains will hold Monday, Tuesday, and then make an assessment. For the week though, cocoa comes atop again by about 11.5%. Rough rice, lots of call options buying on rough rice, so it scored gains of about 10.5%. And then we have VIX futures up over 9%. Copper and coffee up a little over 5% apiece. The losers, platinum down about 6%, lumber down a little over 5.5%, and of course the Nasdaq down about 5.5% in a single week. Let's move on to options, the big casino, and see what's going on here in Friday's session. More appeal for put options. You see the ratios now changing toward the 40s, in some cases 50s and above in certain names. And of course, when we see a lot of buying of puts and the market maker is not prepared, we see the possibility of inverse gammas. At the same time, we always see that when we get elevated ratings in put options, it usually marks the point of a rebound. Specifically in names, if we look at Apple, the IV rank is really important in this case. Whether we're looking at Apple, whether we're looking at AMD or Meta, all of these IV ranks are above 90%, which means that the implied volatility is reaching extremes, and the recent direction has been to the downside. You combine this with elevated buying of puts, you probably put two and two together, and you'll see rebounds in these names. Now, whether these rebounds will be sustainable or not, I don't think so. We'll look at the flows on Friday. ZR, bullish flows, 72 million. That's Rough Rise Futures. We see MicroStrategy, Eli Lilly, XPI. I think I'm buying the dip in the XPI this week too. In the bearish flows, we see them in the E-mini Futures, IWM, the Qs, NVIDIA, Supermicro. The interesting trades, we have NVIDIA long puts, the 1100, 1410, 1280, 1380 for different expiration dates. So these are deep in the money puts. It is highly unusual, but the trader knows exactly what they're doing. They're looking for NVIDIA to trade below 762. If it does, they have 50% chance of profitability. They're probably going to close way before that. But again, folks are always confused. Why do we see deep in the money calls, deep in the money puts? They're really betting on a possibility of higher profitability if the price goes below a certain price. And in this case, it's 762. And I think that they've already achieved their target and they booked profits from this trade. Now we have another one. Somebody bought the 800 puts for NVIDIA for $419, spending about $3.5 million for those. Again, I think that this trade was already closed and they probably flipped that $3.4 million to about $10 million. If we do some unusual activities, smaller ones though, not the millions and millions of dollars, we begin with the ticker PZZA. This is for Papa John's, and somebody sees the name going down. They bought the 57.5 puts for the expiration date, June 21st. The expectations, the name will go down and lose more than 8% of its value by then. Paid about $1.45 a piece to enter this trade. All in all, spending about $3 million. Then we have the ticker DKNG for DraftKings. Somebody sees a rebound coming, and they bought the 44 calls for the expiration date, May 10th. The expectations, the name will move higher and gain more than 8% by then. Paid about $1.60 a piece to enter this trade. All in all, spending about $2.5 million. And then we have Microsoft and NVIDIA puts, so somebody betting on downside for some of these big caps. We begin with Microsoft. Somebody bought the 350 puts for the expiration date, May 10th. The expectations, the name will go down and lose more than 12% of its value by then. Paid about $1.50 a piece to enter this trade. All in all, spending about $2 million. And again, Microsoft is the most important name when it comes to the big caps because it is the strongest. And if it goes down by 12%, then it's going to be a disaster for the entirety of the market. Of course, in the meantime, somebody's playing a rebound in NVIDIA. I think NVIDIA is oversold in the short run, but it might produce a rebound. So it is worth speculating on that. And somebody bought the 810 calls for the expiration date, April 26. The expectations, NVIDIA is going to rebound by more than 6% by then. They paid about $8 a piece to enter this trade. All in all, spending about $10 million. And then we have somebody who's playing a rebound in the Qs, and they bought the 459 calls for the expiration date, June 21st. The expectations, the name will go higher and gain more than 11% by then. Paid about $1.75 a piece to enter this trade. All in all, spending about $2 million. Let's move on and do some charts and then wrap it up. We begin with the SPY, the S&P 500 an hourly chart. What do we see here? We talked about the flush down in the series of lower highs and lower lows. Now, what's really important for you to watch is the behavior of the hourly MACD. There was an attempt for a rebound. We talked about this Tuesday, Wednesday, Thursday. The rebound didn't happen. There was no demand. So if the buyers don't show up, the sellers are gonna. And if the sellers show up on a Friday, the risk of an inverse gamma increases. And this is why we got a nice whack on Friday, a big one. We lost 500, we lost 496, but now we see severe oversold conditions on the hourly chart. I would not be surprised that the market is going to at least try to stage a rebound. What happens if it fails though, Maverick? Because a rebound can get us back to 500, 501, 67, 503 even. That's not out of the picture. That's an ordinary rebound. But what if we continue to go down? Then we look at the daily chart. We lost the gap at around 497.37. Now we have the 100 days moving average in blue at around 492.15. So that would be support number one. Now again, I would actually bet on maybe we have a falling wedge pattern. We get a rebound 503, 504, and then see what happens, because the next move after that will probably be more downside to come. And the reason is, you look at the SPX, the cash index weekly chart, what do we see here? We are at the white line, which is the 20 weeks moving average. Even though we lost 5,000, an important milestone, we can get a rebound of the 20 weeks moving average. Lasts for a day or two. But at the end of the day, look at the strength of the momentum. Looking at the MACD, for example, the momentum that is changing from bullish to bearish. That's just starting, and it has a long way to go. So I think that eventually the SPX, rebound or no rebound, will be heading down to 4,600. If we look at the E-mini futures hourly chart, what do we see here? In the last video, we talked about the double rejection at 50.92.5, indicative of a move to the downside. If we lose 50.22.5, then next stop will probably be 49.72.75. And that is exactly where we stopped. And then we caught a rebound, came back down again, now maybe forming a higher low. Again, I think the odds say that the market at least going to try to rebound at this point. If it fails to go above 50.92.5, then we got a problem. It can go down further from there. But we got to give it the benefit of the doubt for now. If we look at the Q's hourly chart, it's even bigger of a whack, because the majority of the pain came from technology and semiconductor names. And we stopped at 413. My number was 412.92, but that's okay. Close enough. You look at the hourly RSI, really oversold. The odds for a rebound, I would say, highly likely. Question becomes, what if the rebound stalls and down we go again? How far can we go? Look at the daily chart for the Qs. Now we've breached the 100 days moving average in blue, and folks have been saying that the Qs is the leading indicator for the SPY. If it loses the 100, the SPY, SPX will lose its own 100 days moving average too. For the Qs, we have another support at around 408.71. If the chart decides to go further down, then we have to look at that number and how it will hold as support. If that doesn't work out, then we have to talk about the 200 days moving average that will be down to 396-ish. If we look at the NDX weekly chart, what do we see here? We lost the 20 weeks moving average in white. Again, leading indicator to what's going to happen to the SPX. Momentum is now accelerating to the downside, as you can see in the shift in the MACD indicator. I think that at least we have to go down. Rebound or no rebound on the daily, doesn't matter. On the weekly chart, we have to go down and retag the trend line in yellow. That'll be in or around, let's say, 16,000. See how that's going to hold, and then decide what to do next. If we look at the NASDAQ futures daily chart, what do we see here? Oversold, higher volume, stopped at 17,210. Can we get a rebound? Absolutely. But if that rebound fails anywhere before 17,735.75, and it takes out the support of 17,210, then we have further downside to go, and that will be the second leg of the correction. And I think it will take us all the way down to 16,000. If we look at the IWM small caps hourly chart, what do we see here? We finished the ABC leg to the downside. 193 should be a good support. And right now, if you notice the behavior of the chart, maybe a falling wedge combined with improving MACD indicator, that says that the chart is trying to rebound. So we should give it the benefit of the doubt. On the daily chart of the IWM, oversold, ready to rebound, sure, but what if it goes further down? Then we have the 200 days moving average at around 189.60. Eventually though, rebound or no rebound, you look at the weekly chart. We have support at the 200 weeks moving average in blue, but the damage is done, folks. The MACD is changing with a confirmation from bullish to bearish. It has plenty of room to go to the downside. The vortex indicator, at the bottom, you see the red line crossing above blue. That's a confirmation of bearish momentum taking over the bullish momentum. I think it is inevitable that at some point in the Russell 2000 we go down to the lows once again. That'd be in or around 160. Unless, of course, the outlook for interest rates change. But for now, higher for longer, higher rates will indicate that the IWM should be going down to the lows. If we look at the dollar daily chart, we talked about the rising wedge pattern. We got a drop out of it, but now it's over. So if we clean up the chart, do we have a bull flag consolidation pattern that would lead to higher dollar? This is the assumption for now. Absent of what? Losing 105,658 basis points. We look at the old man gold daily chart. What do we see here? It is inevitable that gold is going to lose some momentum and try to correct. For now, folks don't want to sell. But if we eliminate some of the geopolitical risk, if the dollar continues to go higher in a meaningful way, I think the dollar is going to break. We will see a correction. How do we play it? If we look at the GLD daily chart, maybe we have a bear flag. You see the change in momentum in the MACD from bullish to bearish. Maybe we'll play some 210, 200 puts. Maybe we'll play the 220, 210. puts, depending on the pricing, but we're going to look for a play this week against the GLD and maybe perhaps against the GDX gold miners. For now, if it stalls here, then we're probably in for an inverse ABC pattern where the C leg tests the 20 days moving average at wide again. If there's a failure, we finish an inverse ABC pattern. So you got to be careful with the miners here. You shouldn't jump in and buy until we beat the highs from the breakdown candle. If you look at the SLV silver daily chart, again, I see a bear flag pattern. I see loss in momentum in the MACD indicator. I'm not a fan of chasing silver right now. I'd love to see a correction, then I'd buy. And that correction could happen if the geopolitical tensions cool off a little bit and we see a rise in the US dollar because of interest rate expectations. If we look at UK oil Brent daily chart, what do we see here? Clear failure to trade above the 20 days moving average. And we see bearish momentum in the MACD and the Vortex. The odds say we go down for a retest at the lower Bollinger Bands and the next support at 85. So long as we keep 85 as support, we're good. If we lose 85, then we got a problem. Now, if you want to buy dips in energy stocks, XLE, for example, daily chart, you wouldn't want to do that until we close above the 20 days moving average in white. That'll be a confirmation that the correction is over and higher we go again. But give it a little bit of time here before you jump in. If we look at the 10-year yield daily chart, what do we see here? Big rebound from overnight hedging via buying bonds because of the Israeli attack. We wake up in the morning and decide it was a nothing burger, so we see dumping of bonds and yields moving higher again. So it is still a positive pattern. On the weekly chart, we see that we're above the 20 weeks moving average, RSI firming up, MACD indicator firming up, expanding the upper Bollinger Bands, all leading to the conclusion that we're going to challenge the highs and perhaps beat the highs. And that will be the moment where the conversation is no longer about delaying rate cuts, but actually hiking rates again. That's the moment when the market breaks down and drops 20-30% rapidly. If we look at some yield-sensitive charts, the XHB Home Builders daily chart, what do we see here? We got a bear flag that played out, followed by another bear flag that played out, but now we're getting a little oversold. Can we see a rebound in the daily? Sure. Would it change anything on the weekly chart? No. Weekly chart is changing from bullish to bearish. So if you want to short the XHB in the next leg, you want to wait for the violation of the 20 weeks moving average in white. That will be in or around 99.80. You can play a rebound on the daily if you'd like, but it's going to be short-lived, and then the weekly plays out and we see the XHB correcting even more. The same goes for the IYR. Real estate really oversold right now. My bet will be for a rebound, but any stop before the 200 days moving average in blue, 85.14. Failure heading back south. You have to follow the weekly chart because that's already making a lower high. It lost the 20 weeks moving average, and I think just like the IWM, it is heading back to the lows. The KRE regional banks is the exception, and we talked about this last video. On the hourly chart, we see a falling wedge pattern. We see improving momentum, followed by a bull flag. You gotta give it the benefit of the doubt that the managers are still interested in buying regional banks for whatever reason. If we lose 45.50, then we can talk about downside. Here's the XBI Biotech, also rate sensitive, daily chart this time around. Really oversold. It appears that it printed a doji candle and it caught support at the 200 days moving average in blue. I'm inclined to play a rebound for the XBI this week. It might fail at 87, 89 or 90, but I'm going to play a rebound. It's going to be a quickie, day or two, and then we're done. And then we'll see what happens. The VIX hourly chart, what do we see here? We got a gap and crap in the VIX. We did not close above 1888. Sure, we've made a higher low, but the risk right now says, what if the VIX pulls down and forms a lower low? That's highly possible. That's going to allow the market to rebound as the VIX plays a bear flag pattern. And that would mark the end of leg number 1 in the correction. Market rebounds, VIX goes down, and then what? We see the second leg, and the VIX goes higher again. When do we know that the VIX is a buy once again? I would say if you look at the weekly chart, look at the 200 weeks moving average, 2065. Say the VIX on daily basis goes down to 16, even 15.5, allowing the market to rebound. Then surges back up, challenges the highs, crosses above the 200 weeks moving average at 2065. That would mark the official beginning of leg number 2 in market correction. If we look at Apple, Big Kahuna hourly chart, what do we see here? Look at the behavior of the MACD. It tried to rebound and it failed, producing lower lows. We have attempt number 2. I think it will be successful even though we have a bear flag pattern. But I think we make it, but so long as Apple doesn't trade above 170, the damage is already done. The daily chart, way oversold at the lower Bollinger Bands. Can we get a rebound? Sure. But look at the damage in the MACD. We're already registering change in momentum from bullish to bearish. With the weekly chart, the damage is even more apparent. We closed below 165, 67, the prior low, indicating that whatever rebounds we're getting in the hourly, we're probably going to play out the weekly chart and head down further. That's going to take time though. It's not going to happen in a day or two. And we could even see Apple revisiting the 150s, 140s, but one step at a time. I think step number one will be a rebound and then failure, then we head down. And at that point, we can identify targets on the weekly chart. Here's the most challenging one, Tesla, Souffle, hourly chart. It's way oversold on the hourly, no doubt about it. And the bet right now should be for a rebound in Tesla, at least on the hourly basis. Now, the debate will go Tesla's oversold. When the report comes out this Tuesday, the name is going to rebound. What supports this argument? The daily chart. Outside of the lower Bollinger Bands, way oversold. Maybe we've priced in a lot of bad news, and we see a rebound after the report comes out. What supports the other argument, though? That no, we haven't priced it in, and when the report comes out, we'll see a crash. You look at the weekly chart. We have a bear flag that is playing out, and we have a confirmation of the loss of 152.32. Next stop would be the lows from 22, 101.81. And the chart here is not oversold. What if the report comes out and we see a big flush in Tesla, and before you know it, we're down to 101.81? That is also plausible. So it's going to be a battlefield. And this is why I think it's going to be the most interesting report to watch. I'm probably not going to have any dog in the fight, but I'm going to trade both ways. I'll probably have way out of the money calls, then maybe calendar puts. We'll see what happens. But with these targets, with these numbers in mind, for the rebound and the drop, we can identify targets to construct these trades. We'll talk about that when we get closer to Tuesday. NVIDIA hourly chart, what do we see here? We got a rejection at 860 forming a bear flag pattern. Comes Friday, here comes the flush down, losing 842 and just keeps going and going and going. Now the hourly RSI is way oversold. Odds are we get a rebound. If we open flattish in NVIDIA and the VIX is not flaring up, you probably want to go with the 800 calls. Day trade, you make a quick buck, you close them, in, out, hello, goodbye. But the damage is done, folks, on the daily chart. We're expanding the lower Bollinger Bands. And rebound or no rebound on the hourly chart. The daily's probably heading back to the 100 days moving average or closing the gap. 688.88. The numbers are really close. What supports this number or this range is also the weekly chart. So look at the MACD indicator. We're losing momentum. There's no doubt about it. Next stop could be the 20 weeks moving average in or around 700. That's close enough to 688. So I think that if we have a rebound, it'll be short-lived. And then down we go to 688-ish. If that doesn't hold, then we can talk about further downside targets. But for now, it is the 20 weeks moving average. It is the 100 days moving average. Tulips, Bitcoin, daily chart. What do we see here? Again, watch the behavior of the MACD on the daily chart. Is it going to cross at some point and produce positive momentum? I think that's inevitable. Question is, will it be strong enough as to create a higher high in the pattern? I'm not sure about that. But I'm also sure that I'm not going to short Bitcoin until we lose 59,224. Now, what happens with the proxies? You look at Coinbase, that's not looking good. Bear flag, and if we lose 205.77, we got another trade on it. And by the way, I'm making a video about the trade that we got for Coinbase. It deserves a documentary, really. The trade was down by about 90%. And in one day, it came back to life and it scored gains north of 200%. We will make a video to our Discord members about the lessons learned from this trade. Then we have MicroStrategy, MSTR, below the 50 days moving average in blue. It appears to me that it wants to go further down. I'm just not sure if it's going to go further down if Bitcoin is about to correct some momentum and move higher. So watching Bitcoin is really important to me. If we see failure to rebound in Bitcoin, we see a loss of 59,224, the MicroStrategy will probably lose 50% of its value. It is the juiciest trade when it comes to Bitcoin proxies, but it is also a high roller table. It's really expensive. And this is why, while I play puts on both Supermicrocomputer and MicroStrategy, I also have shorts on them because I think that that's the more sustainable way to do it for SMCI and MSTR. The puts are fine. You can play them, but it is just complementary to the strategy of actually shorting the stock. And then we have HOOD, Robinhood. What do we see in this daily chart? Topping head and shoulder, flirting with the 50 days moving average in blue. If it breaks, then we have further downside in Robinhood. Lastly, what about the miners? MARA. The miners actually caught a rebound Friday. The halving event is over. I think now they become not interesting at all as tradable mechanisms. The juice is already out, so we're going to stop covering them. But I think that the majority of the pain has been already squeezed out of these names. Let's move on to the conclusion of this video. What do we have on the economic calendar this week? We have plenty. We begin with Monday, nothing really. So Excellent day for a rebound. Tuesday the 23rd, we have the flash services and manufacturing PMIs. Those are going to be really important. If the prices paid component come out really hot, we will see yields higher, equities down. Then we have new home sales for the month of March. And then Wednesday, the 24th, we have durable goods. So all eyes would be on earnings rather than durable goods, because we'll have important earnings Tuesday, and then Wednesday, the big cap earnings begin to come out. Thursday, the 25th, we have GDP. Then we have initial jobless claims, trade imbalance, pending home sales, all important but not as important as earnings from Microsoft and Alphabet. Friday the 26th, most important day when it comes to the macro. We get the PCE report. This is the most important element for the Fed. If it comes out hot, forget about it, yields will go higher and the market is going to flush down again. And that comes on top of consumer sentiment, the final reading. And with that, folks, this is all I got for you for now. If you found the video enjoyable, please help us out, press the like button, subscribe, leave us a nice comment, consider being a member here on YouTube or on Patreon to access our daily video analysis and other benefits. But with that, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
What have I always told you? Predicting the rain doesn't count.
Building the ark does. I thought that was Warren Buffett.